Welcome to episode 9 of our OR Talks podcast. Today we'll be joined by Stephen to discuss all things business valuations. Here are your hosts, Neil Seeger
and Mark Jovanovic.
So we're joined by Steve. Steve's come to discuss business valuations. And what is he, Mark?
What is he?
What is he? He's our second guest.
Yeah, returning.
Well, he's also a guy, and he's also talks about valuations.
Yeah, I wondered where you were going with it to start with. So what do you mean? What is he?
Well, I suppose. How long we got?
Yeah, returning guest.
Yeah,
he's our second guest.
We'll finish with that.
Yeah. Well, thanks for joining us. So, obviously, what on earth is a business valuation?
It's when we value a business, as simple as that. Quantifying the value of a business using financial information, usually.
Okay.
And commercial information as
so
well.
Is that historic data?
Yeah, usually historic. Sometimes we use future information as well, what they expected to, like, they can look into the future, but come out with some...
I've got a mystic meg there.
Come up with ideas of what their profitability is in the future and that sort of thing. So,
yeah. When would you normally get a business valued? What would be the reasons for doing that?
Divorce is a big one at the moment.
Straight in with the big one.
Yeah, but the divorce rate's at 60% in the UK.
Is it?
Yeah. I think so. Or it could be America.
No comment.
I think it's 60%.
Well, he's busy with the business valuation.
Yeah. Divorce, probate, when someone dies, you value a business because you need to know what the value is. So you get quite a few of those.
Okay.
When someone's selling a business, so when they sell their business to someone, they want to know how much it's worth. When someone's buying a business, they sometimes want to know what we think the value would be.
So whether they're paying too much for it.
Yeah, or too little in a good way.
Oh, as I say, too little is perfect. Too much is not quite so nice.
Yeah, and then share changes. We do share certain share schemes. We need to value the company to understand what the value of the shares are for HMRC purposes.
Okay,
that's generally most of it, I think, in terms of why we do it.
Okay, and so a little bit about sort of how we do it, really, which is a really broad question, I know, but so really, I mean, I suppose is there multiple ways we value?
Yeah, so there's about 6 or 7 general ways of doing it. The most popular ones that we use are the assets in the business. So if they've got buildings and land and cash, a lot of cash in some cases, we'd use that as a basis.
Okay.
Sometimes we use profitability as a basis. We use different measures for that. So it's how much growth we're expecting a business to have, then projecting that. Sometimes we put the two together. And there are other ways of doing it as well. It just depends on the industry as well. Some industries value on a different basis. So, for example, financial advisors have a special way of valuing their businesses.
Yeah.
So, yeah, it's quite subjective. It's very subjective. And whatever we come up with a value with anyway, sometimes it's a case of what someone's willing to pay.
Well, same as everything, isn't it? I could value that glass there at £500,000. That doesn't mean that Mark's going to pay me £500,000 for that.
Certainly not. If I had £500,000, I still wouldn't.
It's very pretty, though.
It's got a logo on it.
It's got a logo
on it, yeah.
Yeah, the logo is worth, $499,000.
Yeah, and the water's worth the other pound.
But it varies on industry to industry, isn't it? So if you're selling a product, I suppose you value it very differently to if you're selling an industry that's got like a service. If you're selling an accountant compared to a glass manufacturer, it will be very, very different.
Yeah, and we have to apply certain industries specific metrics to get to our valuation. So software companies, because they've got a lot of scope to grow quite fast and largely, you might use a different sort of ratio as you would to something that's, if you've got a bin collection company or something like that. I don't know, that was off the top of my head.
Yeah, so they've got different industries though, isn't it? So, different multiples for different industries. You can't apply, the same any multiples or anything else you can be working for to, between the industries, can you? They've all got to be different.
Yeah.
You can't just go with one size fits all.
Yeah, and you'd use the multiples when we're talking about that to use against profit. So to estimate what the future growth of a company will be based on 1 year's profit, you have to times that by a certain multiple, which is where we're going with that.
Yeah.
And sometimes we have to calculate if we use an asset method, goodwill, and what the trademark and intellectual property of the business is worth. So that's where the multiples come into.
It's very easy to work
out.
It's intellectual property and all sorts of stuff sounds very, very straightforward.
Yeah, it's easy work,
Because then again, it is as you said, what somebody else thinks it's worth. Yeah. We can then say we think it's worth this.
Yeah.
But actually, what someone's willing to pay might be very different, and that's the difficult world we have. It's the same value in anything, isn't it?
Yeah. Yeah. It's the same value in a house. You go to different estate agents, they'll say different things because they're valued different ways.
Yeah.
So I was going to ask that. How do you deal with that then? If we valued it something, and someone's selling the business, and then the person buying it has it valued, and they come back with a different value.
Yeah, it's we don't actually. I haven't been interacted too much with people who challenge our values.
Yeah,
sometimes a client might decide that our values, what they want to use against someone else's advice, and they might say no to an agreement or deal. But it is very subjective. So usually when we're value, we'd say it's within a region as well, because it's very difficult to put an exact figure on something. And sometimes when we're valuing assets, we use independent valuers to value the property part of that. So we do liaise with experts to get the most accurate value we can.
So not just sit there thinking about how much you think it's worth then.
Yeah, I sit on Rightmove and I'm like, okay, right.
If only that was that simple.
Yeah.
But we get third parties involved. It's not just us. There's many other people that get involved in that, isn't there?
Yeah, it's always part of a big process as well. Where everything valuation purposes, usually there's legal stuff involved. We have to liaise with solicitors as well. And it's something that we have contacts in. That's how it all kind of comes together.
So I can value how much might affect my trade because that's my profit. That's really, really, really that's probably more difficult than valuing my assets because my assets are what they are, physical items, aren't they? So I can say that glass there that I bought, for 100,000 that's got a book value of 20,000. Actually, I could sell that at market value.
Yeah.
So do market values affect valuations, or is it
just they can do. Yes, when we're looking at larger assets, then we might revalue them.
Okay.
Which is what you do in accounting anyway. Sometimes if you want to change your financial statements to be more accurate. So we do revaluation sometimes it's all based on market value data.
Yeah, exactly. It's not just it's not just a case of simply just looking at a balance sheet and saying, well, that times by 5, there's your answer.
Yeah. And
because there's many factors that affect that piece of paper that has all those numbers on there.
Yeah, exactly. And there's things like stock or goodwill. That's another thing. That's a bit of a nightmare. The minefield to understand.
It changes every day, doesn't it? My stock value would change every day. You do a valuation today, tomorrow that's out of date.
Yeah.
It's always because we're always working on effectively historic data. So unless you value it right now, and then me and Mark decide to shake hands on that glass for £500,000 right now.
Yeah.
Thank you.
Not
Mark.
happening.
If I keep saying it enough, you'll say yes.
I definitely won't.
We've got a valuer sat here. He can value that.
He's got about 10 of these glasses in the cupboard I can go and get. So.
Then we'll charge you for all them too.
We're sitting on a million mine here, aren't we?
We know where our glasses left here this way.
Well, absolutely. I mean, he's dropping in the marketing there. Yeah. I like that. It's clever.
Nice. I don't like
drop.
Yeah,
So when we're valuing businesses, obviously we've said we can do them for a probate point of view. We can do them from a divorce point of view. So are there any really positive reasons we value business apart from sales and because we're going down quite a dark thing. Divorce, death, and sale. Would I value it for any other reason?
We do it for So we do it for management incentive schemes.
That's better. I like that.
That's better. More positive. We have things called EMI schemes, which are enterprise management incentives. That's what it means.
Okay.
That's when you want to bring management of a company into the running of the business and the shareholders part of it by issuing share options, which is just a whole new other thing. But ultimately, you have to value the business based on that.
Okay.
Get approval from HMRC. So that's to incentivize management to
grow the company.
To grow the company. And it's like a succession sort of planning from the existing owner's perspective.
And a succession planning from a family business point of view as well. If Mark was looking to my son, and actually, I decided I was going to bring Mark into the business and actually incentivize him, that would work in the same principle, but on a smaller scale.
Yeah. So we value on that, and you have to value on that, and you have to get HMRC to approve that. So some valuations we do are not for approval; they're just what we believe it to be, and then the client will look at it and then decide based on market value. But because it's not going to an external third party in the case of an EMI scheme, then you will get HMRC to approve it.
Okay.
Because otherwise you get tax charges, which is where it goes with that.
So you do valuations for multiple reasons. It's not just people buying and selling, so it will be from tax point of views as well.
Yeah, so in some cases, if you give shares to an employee outside of an EMI scheme, then you might have income tax charges because it's deemed as remuneration to an employee.
Okay. So the employee would have those?
Yes, yeah. So because of that, we have to sometimes write to HMRC and get their approval to do that and treat it in a capital way rather than income sort of way. So that's another element of it, I guess.
Is that quite an easy thing to do, like liaising with HMRC on that?
It's a bit of delay. It's also quite monotonous. They want a lot of information.
Yeah.
So we have to gather a lot of information, lots of documents. The valuations themselves, the calculations are one thing, but then you've got the documentation with it, which ends up bulking up the amount of work.
That's the time where the time comes into it, isn't it? I suppose doing a valuation is, not an easy process, but it's maybe a smaller proportion of actually the compliance that comes with that.
Yeah, and often when we do valuations, we end up then implementing the share work afterwards. When someone wants to have growth shares in the business or something like that, that's when we go, right, okay, now we need to implement that for our clients.
What's that?
What's
the growth? What does that mean?
Okay, so if someone wants to invest into a business or want to have a shareholding, to make sure we don't have any tax charges by them owning new shares, we will value the shares at a certain point, and then they'll be entitled to the amount that goes over that.
So the uplift. So just put that to a simple thing. So me and Mark have got a really successful business. You're a star member of staff.
Cheers.
We want to bring you in, okay? But then, so we would then, let's say me and Mark, our shares are valued at £1 million.
Yeah.
Okay. So then we the three of us, we're all in business. So you get a nice little growth share, which is effectively at that point on day one is worth nothing really.
Yeah, exactly that.
So in 5 years' time, we sell for £2 million.
Yeah.
Okay. You would therefore be entitled to a third. Let's just say we equally a third of that million.
Yes, that's right.
Of the growth from
the growth. Yeah, and then me and Mark share the rest.
Exactly.
We've worked really hard, and you just come in for a couple of years.
If you say so.
That's in reality
that is the reality.
It's a growth share.
Exactly that. So you've got to value it, get a baseline, and that's where it goes over. And we do a lot of that sort of work. And that involves then legal work afterwards because you've got the documents, the shareholders' agreements, etc. So the whole valuation is just a piece of a big puzzle.
Right. So it's the start of a process normally.
Yeah, it will be. Yeah, definitely. I'd say so.
So if I was then looking to, put a holding company in place or put a group, would I have to value my company at that point as well?
Yeah, it depends.
Okay.
Depends always the answer. We do other things as well, other services to bring holding companies into businesses. And sometimes we can do that tax-free. And when usually it's tax-free, you wouldn't necessarily need to value it.
Okay.
But when there's tax implications because shareholdings are different or you want to implement different people into the business, that's when you start the valuation becomes pertinent. So
it's not a simple process.
No.
That's the thing, isn't it? And that's the key here. It's, business valuations is as clear as mud.
Yeah,
it's a very broad topic. It's like saying an accountant's an accountant. Well, actually, an accountant can do tax. It can be auditors. It can be all sorts of very broad topic. Like valuations are a very broad topic.
Yes,
you can talk about it for the rest of the week probably of all the different things that come into it. But in essence, what a valuation is actually how much is that company worth.
Yeah, and another thing to think about is also someone like a financial director can be often have the skills to be able to, do the calculations to value the business, but then a lot of it is needed. You need a third independent party to be able to establish that valuation for someone who wants to buy those shares or something out of the company.
Right.
So we act as
I was going to say, do we do that then as well?
Yeah, we do. We do a lot of facilitation sort of work where we're kind of giving that third party advice in a way. A lot of the time, it is used as a basis.
Yeah, it's as I say, the start, isn't it? Actually. Because things are going to be challenged and subjective, as you say. I was saying my stock is worth more than the accounts show because it's moved.
Yeah,
so it's all very, it's. I had a client actually when I went to go speak to them about their valuation, and actually we come up with a figure, but things had moved on so much and things had moved up year-to-date figures that actually the valuation we've gone with isn't actually the right value. It's historic.
Yeah. But then they can use that as their basis and go, well, it's moved up a bit. Actually, we think it might be worth this.
Yeah.
So
yeah,
that's So it's never wasted. Sort of a lot of the time we end up doing all the implementation and legal, how assisting with the legal work and facilitating that afterwards. Anyway, so yeah, it's definitely the basis of everything.
So what else comes up in the evaluation world and company valuation?
I mean, if we're talking about probate and stuff like that, when someone's passing something down in inheritance, then they need that valued because when they're working out the sale of the shares to, so let's say your great granddad is alive. Yeah. He wants to pass down some shares in his estate when he dies, and then he does, and that won't usually have a tax charge if it's a trading company.
Okay.
But then the value of that needs to be ascertained, because if you receive those shares and later sold them, that value, when it gets passed down, is what we use.
A bit more base cost.
Base
so anything over and above that I receive, I pay tax on.
Yeah. So we do things like that as well, because if there's inheritance tax involved, and you know quite a lot about that, Mark, but after it's most people, if they're married and they've got their homes covered by reliefs over £1 million, that's when it starts to be untaxable. It's inheritance tax. So valuations also come into play there as well.
So what if I decided, actually, I'm selling my company, don't want a valuation, I don't pay the cost, don't want to be involved in that whatsoever. I'm receiving an amount of money, okay, and then I decide, actually, I want to do a business valuation
afterwards.
Yeah, can I do it afterwards?
You can do it afterwards, but I'm not sure you'd bet. You mean if you'd sell it, so you have a company and you sell it, and then after you've sold it, you go, oh, can I?
Yeah.
How much is it worth? How much was it worth? You could do that. I think it almost defeats the purpose, because then it depends really. You'll think about two ways. You can either value it then and go, oh yeah, I made a great deal there, or number two is, oh no, that was a mistake.
Because there are people that listen to this that will go, well, why on earth do I need a valuation? Why can't I just say it's worth that? If me and Mark decide that glass is worth £500,000, and then I then get upset because actually Mark's just sold it for £2 million, and I hadn't realised, then can I use the valuation to then go back at Mark?
That's more of a legal thing, actually.
Yeah, it is.
I guess it's a
valuation would come in.
Yeah, you're acting blind if you don't have the valuation, really.
So it's really important. That's my point. It's
really important. I don't think there's many ways of doing it once you made a deal, I guess.
Yeah. So before you do anything, you want to get it valued.
Yeah.
And what's that, Mark?
Fair.
And forward planning.
Forward planning.
Those are the really important things, and actually that's what I'm getting at there.
Okay.
I'm sort of having a funny way of actually saying, well, it's really important to do that. Because if you don't,
it's too late.
It's too late. You can't.
Stuff.
So it's really, really, really important. If you are entertaining that idea, thinking of retiring, thinking of getting management into the shares, you think of doing all those sort of things, you've got to think about actually the valuation.
Yeah.
Because then if the valuation is not in place, then you might potentially have some tax things. There's tax implications. We might bring you into the management, give you some shares, because we're not actually specialised in tax. We've got a heating and plumbing business, me and Mark have, who are doing really well, and we bring you in. You're the apprentice plumber,
like Mario and Luigi.
Yeah, right? exactly. We bring you in, and then we say, well, we'll give you some shares. And we turn to the accountant's office and we say, we'll give us some shares. And the accountant says, oh yeah, no, it's a nice little tax bill.
Yeah,
because you haven't thought about actually how we're doing that.
The implications and everything.
The way to look at it is, if you're doing anything share related in your business, or anything managerial related, or direct teams, anything to do with the governance and how it's operating, it's likely in most cases that you'll need a valuation of some sort to establish a route of what you're going to do next.
And off the back of that, we create a plan of how you do that, tax efficiency, all those sort of things. The valuation is, as you say, just the start really. The tax thing is probably number two.
Yeah, we usually often we put proposals together. We pass it to the client and we say, this is what we think you should do in the long term, in terms of this is our long term strategy. This is what we're going to do, and the valuation will be a step of there.
We don't just value; we do
documents where we structure, plan together.
Okay, so it's not just you come in, people value it, and then that's it. Off we go.
No, it's a plan. Yeah, it's a plan to say what we'd do, why we'd do it, what tax saving you'd get to be transparent with the client. Then here's the valuation. Here's the next steps if you would like us to do them, and do that for you. And obviously we can do a lot of share work here because we have a company secretarial team, and we have the tax advisors for that.
So it's all in-house?
Yeah.
So you can come to us as a one-stop shop.
You can do everything. Because it is accounting implications as well, then that's good, because if you were your accountants around your compliance, then feeds in there. And then if you want a new director on payroll, we do the payroll. If you want VAT advice on that, so it all fits in together.
That's it. And these are things that people won't necessarily realise that we can help them with as well, isn't it?
Yeah, so correct.
Yeah. I always say, because we do the valuation in what's called the corporate solution team, but everyone in the firm gets involved in that without knowing.
Yeah.
We have, it goes as far as VAT, bookkeeping, payroll, accounts, personal tax, corporate tax. We do all of it. It just fits in.
Everyone has to work together, really, don't they?
Yeah.
So if I'm an accountant with a practice that doesn't have the benefits that we have all working together and the family we've built, can they get valuations from us as well?
Yeah, of course they can. Yeah, so we're starting to. We've always had it, but it's always been on a less commercial basis, but taking work from smaller firms that don't have the capabilities of doing it. So if they say, we want to refer our clients to your business to do valuation, then we can start doing that. And we have done it. And past week, I've had about 3 come through that were to do.
So it's not just our own clients that we do.
No, we should be in case it's accountants, smaller accountants, just normal bookkeepers, people out there, just one-man bands, solicitors. We get a lot of work from solicitors sometimes because we refer work to them. So it kind of works on a sort of exchange basis. Any sort of financial, even financial advisors, I suppose, as well. Any sort of intermediary in the professional world can use us to do that aspect of work for them.
Yeah, so if I was selling my business, not only could I actually have it valued, then I could actually have, as you say, the step-by-step thing, and actually know where my tax planning is going to be going as well.
Yeah.
It's not just a number on a piece of paper saying, "Oh, that works." That's about what we think it's worth as well. To be fair,
so more of it's more tax than anything else, really. And we look at the account side of it, but all the corporate planning we do in terms of valuations, everything else is all based around tax.
That's what people have to pay at the end of the day, isn't it? So
yeah.
Oh yeah, exactly. Yeah.
Should be the only driving force, but it's important, isn't it? It's what's going to cost you.
That's an interesting question, actually. Within the valuations and that sort of stuff, is most people's concern the tax, or is most people's maximising their value of their company?
It depends. Some of it is to do with the governance and how they want certain management to direct the future growth of the business in a different place. Sometimes it's diversifying risk, so moving properties out of trading companies into a holding company. So what would happen in that case is it splits the trade off from the assets, which means if the company got sued or is in financial trouble, the assets protected. But in that sort of group, it's also still applicable to have inheritance tax reliefs. So there's lots of tax planning involved in it. I think to answer your question, I think it did, didn't it?
Yeah, so it goes on different avenues as well, doesn't it? It's so some people's driver that come valuations will be tax, and so you've got a bit of a double-edged sword, haven't you? Because you want to achieve the maximum value you possibly can because you want to sell it, but you will also equally want to minimise your tax exposure.
Yes.
So you've got a double-edged sword, because the more you receive, the more tax potentially you're going to pay.
Yeah.
But then, so people probably come with different drivers. Some of them come in straight away with, I want to pay no tax, because who wants to pay tax ultimately? Obviously we've got to, but and then but equally we want to make sure we get as much money as we possibly can for our, our company or our asset.
I think the valuations work's usually driven on business strategy as opposed to tax incentive.
Okay.
I would say, and that's where the main driver is, but they don't realise the tax incentive. And then we come up with a plan and say, this is what we're doing. Actually, this is all the tax you're going to save. And as soon as that happens, they're like, oh, brilliant idea.
Yeah, that comes from forward planning there, doesn't it?
Correct.
If you're acting reactive, then probably not going to get the tax savings, whereas doing it in advance, helps with the tax. So.
Absolutely, exactly. Keeps it all nice and simple. And I think that's the message again, isn't it? Forward planning. Yeah. If you are thinking about selling your business or restructuring or bringing management in, before you even have the meeting about doing that, find out your figures.
Another thing I thought about as well, we also do valuations for trusts as well. So when you bring things into trusts, you've got inheritance tax implications. So we do a lot of things like that to understand how much of a business you want to put into a trust.
Why would someone be doing that then? Why would they put that into a trust?
To protect take it out of their estate for inheritance tax purposes. So if, let's say, Neil's dad had, use an example.
Yeah.
So
your granddad.
Yeah. Your granddad. Someone wants to take some, they're near over £1 million in their estate, which is then liable to inheritance tax in most cases.
Yeah.
They want to reduce that down to £1 million, so they're inheritance tax free. Let's assume they've got a wife and all the other criteria they need for that. And they want to move £300,000 out of their estate into a trust to take it out of inheritance tax. And let's say their business is worth £1 million as well. So they want to move 30% of that, of their shareholding, into a trust.
Okay.
So we might value the company, work out how much 30% is worth, then move that into a trust.
Right, okay.
It's a good way of doing things, and it can kind of pass inheritance tax almost down the line and out of the way sometimes in some cases.
It's case by case.
It's
very general.
Yeah. Trusts get very complex.
Yeah,
we're not going to do that today. We're talking about valuations of the week.
Yeah,
the rest of the month on trusts we could probably do.
Yeah, we do. Yeah. And it's not something that I'm necessarily expertise in, but we have got experts for it. So
they can be very tax efficient, can't they? So,
yeah. But it's case by case, and whether that works or whether it doesn't work. Because some cases it will work really well, other cases it won't work really well.
Yeah.
It just depends again what your drivers are and what your end goal is.
Yeah. So valuations is done for 100 reasons, but they are usually strategy provoking rather than tax. But then we usually highlight the tax. If someone approaches us, it's usually because they want a strategy done.
Yeah.
To understand how they're going to pass on their business to new shareholders or something. But if we're suggesting it, it's usually from a tax point of view.
Interesting.
So yeah, there's lots to it.
Valuations are very, very, very interesting, actually.
Yeah,
and useful.
Yeah. And useful. Useful for 100 reasons. I'm going to ask him all 100 in a minute as well. He specified 100, so I'm going to start counting.
Did I say 100?
Yeah.
We've got it on.
It's on camera and record. So what's number one? No, I think the message. I think we've sort of hammered the message a little bit that it's really important to do them before you act on anything.
Yes. Yeah.
Any questions on them, please?
Seek advice from us.
Exactly. Any questions, Mark?
No, I think you've covered everything really. It's been learned quite a bit there.
Lovely.
Thank you. Until number 3.
We'll see.
Thanks for joining us.
Thank you. Cheers. Thanks for joining us today. Hope you found that interesting and learned a lot about business valuations. I certainly have.
Yep, so have I.
That's good stuff. If you've got any questions, please drop us a WhatsApp on 01905 777 600. Next time, you'll be ourselves discussing the autumn statement that the Chancellor will have announced.
All very exciting. Let's hope we've got some nice things to discuss.
So tune into that and we'll go over it and update you on anything that jumps out at us as interesting and relevant for you.
Thanks for joining us.
Thanks, everyone.